Ladies and gentlemen, good day and welcome to the Q4 and FY’25 earnings conference call of Senores Pharma Ltd. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Prashant Nair from Ambit Capital. Thank you and over to you.
Yeah, thank you. Good afternoon, everyone. On behalf of Ambit Capital, I welcome you all to the Senores Pharma 4Q FY’25 earnings call. We have the following members of management with us: Mr. Swapnil Shah, Managing Director; Mr. Sanjay Majmudar, Chairperson; Mr. Deval Shah, Chief Financial Officer. I now hand over the call to Mr. Swapnil Shah to take it forward. Over to you, Swapnil.
Hi. Am I audible? Are you able to hear it properly?
Yes, we can hear you.
Okay, good. Good evening, everyone. Thank you for joining us on Senores Pharma Ltd's Q4 and FY’25 earnings conference call. Along with me on the call, we have our Chairman, Mr. Sanjay Majmudar, our CFO, Mr. Deval Shah, and our IR team from SGA, our investor relations partner. We have uploaded the results, press release and investor presentation on the stock exchanges as well as on the company website. I hope everybody had an opportunity to go through the same. Continuing on our laid out strategies, we have delivered a resilient performance across segments in Q4 FY’25. In the regulated market, we have expanded our ANDA portfolio. We have acquired 14 ANDAs from Dr. Reddy's, one from Breckenridge. This takes our portfolio to about 61 ANDA products, of which large number of ANDAs have potential of catering it to large government contracts in the US, giving us an edge to enhance our market share. The product acquisitions are in line with our strategy of inorganic expansion to grow our product basket. The acquired ANDA basket is spread across CNS, cardiac, antifungal, and multiple of other therapeutic segments as we speak. Our total commercialized ANDA portfolio stood at 22 products as of 31st March 2025. As you know, constantly changing tariff scenarios have made global trade dynamics very volatile. However, we should be able to navigate the situation comparatively better. Our US FDA approved manufacturing facility located in the US, through which we cater to our regulated markets, give us a considerable advantage versus players who do not have the manufacturing footprint in the US. Hence, we should be insulated from any tariff-related risk which other manufacturers might face. On our manufacturing side, we already have 2 operational lines and 2 more operational lines that are in works. That should give us a sizable volume output going forward. Having said that, there was some holding back during the quarter in terms of commercial launches by a few of our marketing partners as we speak. However, we are seeing the momentum pick up massively. On some of the launches, they were slightly delayed. We have launched some products in the ongoing quarter, and we are optimistic of the momentum to remain steady going forward. As of now, we are planning to launch around 31 ANDA products in the regulated market in FY’26 and 23 CDMO/CMO products in the current financial year. Our CDMO/CMO segment is seeing steady traction with scaling up as well. We have added 1 product last quarter and adding more as we speak today. Our portfolio now stands at about 22 products. We have around 69 products in CDMO/CMO pipeline as of March 2025 at various levels, of which many of them will be commercialized in the fiscal year as we will keep on adding portfolio. The moat in our CDMO/CMO segment comes from our ability to cater to government contracts and ability to manufacture and supply controlled substance in the US. With DA, BA certification for our manufacturing facility gives us a considerable advantage compared to all other competitors. We have seen healthy growth in our product segment in all our regulated market business, which is our largest business, continue to show consistent growth driven by the portfolio expansion and increasing market penetration. Our existing portfolio and the pipeline in the own product segment, coupled with the contracts in hand on CDMO, CMO segment, gives us a good visibility for the next year in the regulated market as we speak. We'll continue to double down on our regulated market business, particularly in the U.S., apart from expanding the newer micro markets. The focus will be on faster expansion of our own product portfolio with fast-tracking approval on the CDMO, CMO segment. As we see, we will continue to look for more inorganic growth opportunities in the current year and the coming years. Coming to emerging market business, we have registered 48 products during the current quarter, taking our portfolio to 285 registered products as of 31st March 2025. We have filed 9 more products during this quarter. With the current product pipeline, we intended to have a portfolio of 650 plus registered products across all emerging markets by end of FY'27. We expect the shift in our product portfolio towards more niche molecules and change in our go-to-market strategy to lead to considerable increase in realization, which should drive not only the growth but also improvement in the profitability of the emerging market. Emerging market business will continue to be more profitable and grow, and will continue to grow with changing product mix as we speak. Having said that, we do not anticipate any material change in our product, our revenue mix on a steady state annual basis. We'll continue to have about 70% revenue coming from regulated market and about 30% revenue coming from our emerging market. There might be some fluctuation on a quarter to quarter depending upon the product mix and product launches. Our margin would slightly be up or down depending upon, again, the regulated market, emerging market product mix, our revenue mix, as well as the launches and so on and so forth. We continue to maintain our margin in the range of 24 to 26% sustainable on annual basis, which we have been doing it so far. In terms of segment-wise performance, Q4 FY'25, our income from regulated market grew 17% to 64 crores, and our income from emerging markets stood at about 37 crores as we speak. Coming to our full year performance, income stood at 410 crores, reflecting a massive growth of 91% over FY'24. This growth has been driven by both regulated as well as emerging market business. Our regulated market income grew at about 69%, came to about 245 crores. Income from emerging markets stood at about 121 crores, reflecting a 170% growth over FY'24. Our consolidated EBITDA for FY'25 showed massive growth of 145% and came in at about 102 crores as we speak. EBITDA margin stood at about 25% for FY'25, reflecting an improvement of about 540 basis points, about 5.5% over FY'24. We continue to maintain strong EBITDA margin in regulated market business. We have also delivered on our strategy of improving the profitability in the emerging market business with EBITDA margin at about 7% current year, which is likely to improve significantly in the next year. Consolidated profit after tax and minority interest for the year stood at about 59 crores, a massive growth of 86% over FY'24. To summarize, we have witnessed a healthy performance across segments in quarter as well as a full year basis. We are confident of continuing to deliver sustainable, profitable growth going forward. With this, I open the floor for questions and answers. Thank you.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question on the line of Naitik Mohata from Sequent Investments. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. So my first question is regarding our financials which are posted, right? So the P&L which is posted and the P&L which is mentioned in our PPT, so the revenue, other operating income and other income, the classification among these three differ. So could you just give more clarity on that?
You mean to say what is the difference between other operating income and other income? Yeah, they will say, yeah. So
yeah, exactly. Like what is other operating income about and what's other income about? Yeah.
Yes. So the figures which have been uploaded are as per Ind AS, and what is in the presentation is, I think, somewhat quick. And other operating income mainly includes the product-related service income, then shared service exports. So we have given that breakup in the presentation, if you can see.
So I'll just elaborate. The product-related service income is pure operating income like dossiers, R&D, consultancy, etc. that we recover. Miscellaneous other operating income is typically shared services that we charge, then some write-backs which are routine in nature, and some recoveries, incentives, for example, some export incentives, etc., all clubbed. They are all pure operating income, but classified as such as per the Ind AS. And then we have a net gain or loss on the foreign currency fluctuations which are realized. So this is the realized gain and loss, which has also been shown as other operating income. Other income is a pure interest income, which is sort of a treasury income. So we have segregated that surplus funds that we have kept invested, uska jo interest mila, wo isko other income mein rakhe.
Sure, sir. Understood. So second, could you share the split between our ANDA business and the CDMO business in the regulated market, as well as the margins for both the segment?
See, we generally, as a matter of practice, and also for maintaining certain business confidentiality, we don't give segregated margins between the regulated ANDA income as well as CDMO. So in Q4, the total income of regulated markets, as Swapnil said, was 55 crores, and 244 crores was the regulated market income in entire FY'25.
Sure, sir. Is it fair to assume that the margins for both the segments would be around 38 to 40%?
No, they would be upwards of 40%.
Oh, okay. All right. Also, sir, another question is like we are going for an aggressive.
This is the total regulated market EBITDA margin, consolidated, upward of 40.
Yes, sir. Understood. Also, sir, we are guiding for an aggressive ramp-up in FY'26 in both of our business, in regulated market as well as emerging markets. So, sir, would we see this ramp-up coming up from Q1 itself, or will it be skewed somewhat more towards H2?
Yes. So we feel there is a ramp-up going to happen from Q1 itself, but it will be sizable on the second half of this year because of certain product launches, certain approvals that are expected, certain niche products that are going to be approved in month of September, October timeframe.
Okay, that's very helpful. Lastly, sir, I have a question regarding Senores Pharma. I believe it is another listed entity which of the promoter group that deals in marketing of API and formulation. So it seems that business is quite complementary to our emerging market business. So just wanted to get a sense regarding what is the rationale of having two separate entities here.
Yes, so I think there are two perspectives of it. One is one company purely on a B2B business and other companies purely on a B2C side of the business. One is completely manufacture products in-house. One is doing only most of 95%, 97% are outsourced, right? So very distinctively different business. If you drill down in terms of the fabric of how each business is structured. Largely for Senores, it's oral solids and injectable as we speak. Whereas another company has multiple dosage forms, multiple therapeutic areas, multiple different things. So very, very different business if you really deep down see each fabric of the business.
So, Remus is actually a pure distribution company, and it also acts as one of our many distributors in certain markets. So that way, absolutely there is a little bit of complementary part, but there is absolutely no conflict. And I think our sales to Remus as a distributor would not be more than 3%.
Okay. All right, sir. That's really helpful. Thank you, sir, and all the best for the year ahead.
Thank you.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question on the line of Gaurav Agarwal from 9 Capital. Please go ahead.
Hi, sir. So you gave clarity on other income. Can you also help us what kind of run rate, on the reported basis, the filing which you report on BSE, on that, what kind of trajectory in the other income you can see for next year?
In terms of your visibility, see, more or less, I would say that if the total other income this year was about 22 crores, मैं समझता हूँ कि
it is 19 crores. I think so it is 19 crores for full year.
Sorry, 19 crores. It should be in the range of 15 to 20 crores. वो range रहेगी. Around 15 is a more sustainable number. 15.
So this 15 which you are referring to, this is the service income and other operating part, or it includes the interest income also? Which...
Yes. So all product related service incomes and other operating incomes. And you know why I am excluding the FX gain? मैं वो FX gain को नहीं consider करता.
You should do that. That is the right way to do it. So you are saying excluding forex gains and excluding the interest income, 15 crore other in 15 crore. Okay. And how much was it in FY'25? Like of this 19, how much was it for this year versus this 15, like to like basis?
So 15 is roughly 15, 16. That is exactly what I said.
So मोटा same ही रहेगा, मतलब this year and last year.
Yes.
Okay, sir. In terms of your P&L, your employee expenses have seen decline. On a YOY basis, it was 18 crore last year in Q4. It is only 14.5 this time, and sequentially also there is a decline. So what explains this decline in employee benefit expenses?
I think. Okay. So I think during last year we had some extra shifts going on, which added to our employee cost last year. And plus, there were additional contractual labors which we did this year, which reduced our own employees. But now it will again be back to, because we already employed new people this year for the expansion done. So more or less we'll be reaching what we were at in 2024.
Okay.
Yeah, so on an annual basis, of 60 crores, then there will be a proper regular increase only year over year.
Okay. And the other expenses, is there any R&D component in other expenses in this quarter? And if you can help us, what was the quantum?
Yes, there are 3.5 crores of R&D expenses for the emerging market.
Okay, and for regulated?
Pardon?
For regulated, 3.5 total R&D expenses, or it pertains only to the emerging markets?
3.5 is the R&D component of the current quarter, which is the total R&D cost that is debited to P&L this quarter.
Okay, and what was it, sir, in the previous quarter in Q3?
Q3 you are asking, Q4 24?
Q3.
Q3 we'll have to come back to you. We'll take it offline. We'll just come back to you. No worry.
Okay. Sir, any guidance for next year, if you can quantify your guidance?
Yeah. So, on a top line, we already, during our last call, we already given quite considerable growth trajectory, at least 50% plus top line growth from what we see today. That's one way we are targeting. On a PAT level, we are targeting at least 100% growth from where we are today for the next year. And
this is on a full year basis.
Full year basis. Yes. I think whatever that is there today in terms of all the CDMO orders and our own product launches and so on and so forth, I think it seems pretty comfortable for us to target that kind of number for the current year.
So the PAT guidance of 100% that you're giving, that is after minority interest, right?
Yes, around 100%.
Yeah.
Yeah.
Yes.
Perfect. Sir, just a last question, if I may. Any part of the current quarter revenue which got shifted to, let's say, in Q1 of this year? Because in last quarter, I think the guidance which you gave, right, so we have hit our guidance, we have met what we guided for, but it came on the lower end of our guidance, right? I think we gave a range of around 410 to 440, and we did 410 if I include the other operating income. So is there anything, any setback or any order which, got delayed or got shifted to Q1 this year?
Yes. So, about 15 crore of revenue that we anticipated in Q4 quarter that could not be realized. Two reasons for that. One is, one of the packaging line had to start in month of March. That kind of pushed to April because we had some track and trace compatible issue for that particular packaging line. So though we had tablet capsules manufactured and packed in a drum, we couldn't pack it in a bottles and ship it to our customer because of track and trace issue, IP issue that we had encountered in month of March, which is rectified and done. The second component was we had a product launch with one of our prime customers that kind of got delayed by another 15-20 days, which is scheduled to launch anytime now as we speak. So those were the two factors kind of shifted are about 15 crore worth of revenue from previous quarter to current quarter, which if you add both on the revenue side as well as profitability side, considering those PAT and EBITDA margin, if you add those, then probably you would...
It matches with our guidance.
Yes. And this is for the regulated market.
Yeah, only regulated.
This is for the regulated market.
Right. Great, sir. Thank you so much, and all the best for the future quarters. Thank you.
Thank you.
Participants who wish to ask a question may press star and one on your touchtone telephone. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question on the line of Ajinkya Jadhav from Chris Portfolio PMS. Please go ahead. Mr. Ajinkya, can you hear us? Mr. Ajinkya Jadhav, can you hear us?
Can you hear me now?
Yes, we can hear you now.
Yes.
Please go ahead.
Yeah. Sure. Okay. You have this Atlanta facility, and that's the regulated market day, and that for that, do you have any imports that you do for the production in that premises or in that factory? One. And the second question is, I'm asking you because if you are importing anything that could get affected by the tariff. One. And the second thing is about the new drug policy which has been talked about. Will that put pressure on you to hike the prices or pass through the cost or the reduction in your generic products?
Yeah. So currently, as we all know, there is pharmaceutical is exempted from any tariff that we speak. Secondly, currently for most of our products, we have adequate API supplies, API inventory that's available with us. So any tariff would probably be seen. We don't see any impact for next 6 to 9 months because we adequately have inventory on APIs that we produce. What kind of tariff is going to come in what segment, whether it is API, formulation, some APIs are exempted, some not, nobody knows, right? So we will, as everybody is equally watching it, we are also closely monitoring it, right? So as we move forward, things will get clearer. But from our standpoint, we have only one product coming out of China, and that for that particular product, we have about 2 years of supply already with us on the API side. So even if that is something drastically comes on that side, we don't foresee any large change in terms of our cost of manufacturing on the Chinese API. Also, we have a lot of API, let's say for controlled substance, most of APIs are locally produced. So that we don't foresee a major change from that side. And anything from Europe and India will continue to watch how things evolve. So that's one part of it. Now coming to the second point, in all the speeches you will hear two terms, two words from Mr. President. One is equalization, and the second is most preferred nation. Now when we talk about equalization. Now, equalization is you can only equalize when the product packaging, product strength size is equivalent to it is sold in other markets. Most of the products that is sold in the US and other markets, they do not have the same packaging. Europe is all blister packaging, most of it is blister packaging. US is all bottle packaging, right? So how that equalization will derive in terms of product parity pricing, we'll have to see and get more clarity in terms of how it needs to be done. Also, the stability in Europe is sometimes different. The stability that we do in the US is different. So there are multiple factors that will come in equalization. Now, the second term that we keep on hearing is most preferred nation. Now, if there is no equalization, then the question of most preferred nation doesn't come into play. What I feel personally that this is largely driven towards innovator, where the innovator packaging and everything is same across the globe, whether it is in Europe, US, or any other part of the world, where equalization can kick in because it's got same exact specification, both on the packaging side, product strength, and multiple other factors that we speak. So we will continue to wait and watch what happens. But best of my understanding is concerned, I think we should be fine.
Yeah, there should not be any
material impact, yeah.
But we'll see.
So can I ask one more question? This capex for your injectable that you are planning in US, that capex has commenced, or when will you start your production there? I mean, tentatively.
Currently, as we speak, the capex will be planned sometime end of this year. We are increasing our oral solid capacities, as I mentioned in my opening remark. We already got 2 installed lines. We are getting third line installed as we speak, and fourth line is being planned. So the reason why there is a solid expansion on capacity is because of the kind of traction we have seen because of multiple factors, right? There is a tariff talk, there is a large basket of portfolios that we have acquired, for which we also need to increase our capacities. There are a lot of traction on the CDMO, CMO, which we continue to hear across the board, right? So, our focus, again, we don't want to kind of slow down on our oral solid expansion. Whatever business traction that we are seeing, we want to capitalize most on it and try to gain most as we speak. So, post this expansion of oral solid, we'll continue to do on the injectable side of the business.
And just to add to what Swapnil said, on the India side, we are very aggressively looking at the new site, new greenfield site, which we want to start very soon. In parallel, which would be actually in a medium to long term, again aimed at semi-reg as well as some support to the regulated markets from India. So, but currently it is the semi-reg focus where we will be starting. Hopefully very soon as we are able to finalize the land.
Oh, I see. Okay. So this domestic business, which is there now, which has been, that has done the merger.
So when do you actually look at the margin takeoff for the domestic business? Because it's hardly anything. So of course, we are working on various strategies, appointing distributors and choosing and doing the product mix. But when do you think the margins will come, which will look decent, maybe in at least high single digit? Can you throw some light on that?
Sure. So, when we acquired in 2021, and the company had a PAT negative, it was cash flow negative, EBITDA negative, PAT negative. From those days, the number of percentages, the kind of percentages that was bleeding on the loss side, we have already become EBITDA positive. Last year, we had a lower single-digit EBITDA. This year, we have higher single-digit EBITDA, which the trajectory on EBITDA will continue to increase to double-digit, mid-double-digit as we move forward in next few quarters. So if you see overall, the EBITDA margin is expanding, will become cash flow positive as well on emerging market side. That is one aspect of the business. The second aspect of the business, as you can see, number of registrations, when we acquired this and where we are today, it is almost more than doubled as we speak. And next year, one more year, it is going to double from what it is today. So with the new registration product approvals that is coming in from multiple different markets, you will see product mix changing. Product mix changing will change for unit cost of the production that we are doing. Again, remember this, we are not doing any CapEx or capacity expansion on emerging markets. What we are trying to do today is changing the product mix. We are trying to increase our per unit realization of the CapEx that we have already done. So we start with currently we are about 1.3, 1.4 rupees per unit. We want to become and will become at about 1.8 to 2 rupees in next few quarters. Again, I'm saying we are not increasing any CapEx. What we are doing it is over here just changing the product mix and increasing our realization. That will automatically derive into our EBITDA margin growth and then eventually our PAT growth on emerging market business.
Oh, fantastic. So this, whatever the NDA that you had acquired from Dr. Reddy, have you started working on that?
Yes, we have already started working on it. We expect commercial launches of the acquired portfolio from Q3 onwards.
In a phased manner.
Okay, yeah, it will all be in a phased manner. Okay. And your own drugs that you do, under your own brand, how are they performing actually?
So our own products, you mean our own ANDAs, right?
Yeah.
So it is continue to grow, right? As more and more products get approved, we launch more products. We've seen consistent growth on our own products as well. Even our existing commercial products also, we have seen some of the products having a larger market share than what it was in last couple of quarters.
But just to clarify, we haven't yet launched our own brands as such in the regulated market.
Oh. Okay. I thought you sell it to the pharma company, right?
No, which are sold by the large distribution or pharma companies in their respective brands. So our revenue model is licensing fee, COGS plus margin and then profit share.
So that, I think this thing will continue. Rather than doing your own brand, that will cost a lot.
No, we have a different strategy. We will talk about it as we reach there.
Okay, fantastic. Thank you. That's all from me. Thank you. All the best.
Thank you.
Thank you. We have the next question on the line of Deep Gandhi from iThought PMS. Please go ahead.
Hi, sir. Thanks for the opportunity. So, sir, I had one question on two of your products, which are tamsulosin and tofacitinib. So can you talk about these products, what kind of revenue you did from these two products in FY'25? What kind of market opportunity is there for these two products? If you can talk about that.
So which was the second product?
Tofacitinib and tamsulosin.
No, they are both focused on the ROW market. We have filed it in multiple markets as we speak, both on IR and ER formulation as well as oral suspension. But particularly as a product, tofacitinib will continue to grow and expand because it's going to be a blockbuster. It's already blockbuster in the US and has become a blockbuster in the rest of the world market as well. It's largely used for rheumatoid arthritis as we speak. So yeah, it will continue to expand. Any particular guidance on that product? I think that we don't have and we don't intend to.
Product-wise guidance we are not giving.
This is not
And tamsulosin is a very old age product. It's a prostate product. So I don't know what exactly you are looking to understand.
Sir, I was just asking if you can share what kind of revenue we did from these two products in FY'25 and what is the market size for these products. I'm not asking for a guidance.
Well, they're all, tamsulosin is a pretty old, well-established product. And, it's a good product is all I can say right now.
Any number you would like to share in terms of market size?
For the emerging markets, our current strategy is try to do as many unique products or first to file kind of products as possible. So I would say almost 25% of the new product registrations that we have done would be respectively either very, very unique in the sense that they would be either first to file or maybe one or two filings in those categories. That's the strategy. Now, it is very difficult. We have a very huge, significantly large product portfolio for the emerging markets and there to track. And again, one particular product may have multiple strengths, would have different combinations. So it's for the emerging markets, it is more on the geographies, which distributor, how much market share we want to garner. So it's a very detailed exercise we do. But broadly speaking, we do expect a lot of growth. I think in this year, the margins must move almost close to double digit or rather a little lower of the double digit, and then ultimately our target is in next 2 years they should move in the range of 15 to 16% EBITDA. This is the target for EM.
Thank you.
Yeah.
Thank you. We have the next question from the line of Viraj Shah from Wealth Alpha Advisor. Please go ahead.
Yeah, good evening. Congratulations on the good top line growth. Sir, I have just two questions. Sir, one in the CDMO segment, which are the therapy areas which we are working currently right now on?
Yes. So on the controlled substance side, largely that we are working on the CNS. Within CNS, we have ADHD and the pain management, and on the other side we have pain management. So on the control, CNS and pain management are the sectors that we are operating in. On the government side and unique products, so on the NDA also we have a pain management product that are working on with the CDMO, CMO. On the government side, it is all therapeutic agnostic, right? So wherever there's an opportunity for us to bid for a certain business, we develop it through our partner or through ourselves and bid for the government business, right? So that largely on a therapeutic agnostic on that side.
Okay. Sir, also, if you could just let me know average contact time frame for the customers in terms of years or something, if you could mention that.
Can you come again? Average what?
Average contact time frame with the customers.
Contract time or CDMO?
Yes.
It varies from 2 months to 4 months depending upon
contract
period.
It's 5 years.
So no, not for government. It's 5 years. For non-government, it could be as high as 10 years, 12 years, depending upon what kind of product, where it is going, how it is structured, so on and so forth. If it's NDA, it's probably going to be lifelong, as long as the product is there. So it depends. I mean, depends on the area of distribution and the product that we are working on.
Again, most of our marketing for our own products, most of the marketing agreements are also minimum 3 to 5 years or 5 to 7 years rather. Just to add.
Understood. Sir, also if you could let me know on the competitive landscape of CDMO segment. So just wanted to know around how is the customer stickiness for us.
So competitive landscape is only one today for us is we provide them end-to-end solution, right? With our R&D both in the US as well as in India, with our manufacturing in the US, with the regulatory 100% in-house, complete project management support. Within the project management, we talk about R&D project management as well as supply chain, post production, complete regulatory filing of dossiers with FDA, post filing all the query responses, any additional work that need to be done. So we literally handled our customer right from the product idea to launch of a product, right? So that's our USP. And being a multi-geographically present, this really gives us an edge compared to all other competitors that exist in the marketplace. Plus, not everybody is able to do C2, C3, C4, C5 on the control substance. Lot of people do not have that kind of infrastructure with their manufacturing plant. So a lot of those factors attribute to our uniqueness, unique proposition that a partner would look at it before awarding us the business.
So just to add, there are currently, to my mind, not more than 4 or 5 players in US who are actually providing or having that capacity and capability to provide this end-to-end solutions. Correct? And then quite a few large plants have been closed by our some of the companies whom we all know. So I think we have a fantastic order book and visibility on the CDMO CMO side, and we continue to be very excited about it.
Sure, sir. Well explained. Sir, also if I could just squeeze in one. Sir, just wanted to know on the new API facility. Sir, what is the capacity at the plant, and how once it scales up, how will we see third-party sales? How much a captive consumption for the formulation business?
Yeah, so the new facility is about 100 to 120 metric ton production capacity. We've already started production, but it will be in a full scale probably in about a month's time. The new facility. We expect in Q2 2026 calendar for FDA, US FDA trigger for our API facility. And post our FDA trigger, we are going to start with one of our existing products to get the FDA trigger. And post our trigger, a lot of those strategic products we will do a backward integration and supply to a US business from our plant. And multiple discussions are ongoing in terms of utilizing current capacities till we get a US FDA trigger.
Sure, sir. Sir, thank you and all the best for the next year.
Thank you.
Yeah, thank you.
Thank you. We have the next question from the line of Varun M. from Scaniva Capital. Please go ahead.
Good evening, and thank you for the opportunity. So in the presentations, we have given a split between our regulated market and emerging market business. So I just want to understand our rough revenue split in terms of percentage between our formulation, API, and CDMO, if you can.
The regulated market is around 60% plus as we speak. Emerging market is 30%, and balance is between the API and other things. Critical care and API.
Okay. I mean, all the regulated market would be formulations, or even API goes to a form?
No API. No API formulations out of our US plant.
Sorry, can you come again?
formulations only from our U.S. plant.
Okay. So our APIs mostly goes to the emerging markets, is it?
Yes. And that too, currently it's a very small business, just about 20 odd crores, but going forward it will grow once the new facility is validated and we start producing.
Okay. And what about CDMO?
CDMO is 100% currently. Again, we are talking of regulated. It forms part of the regulated markets business.
Okay. And CDMO has formulations or APIs also for us?
Only formulations from US plant.
Okay. So in the presentation, we mentioned that we are setting up a greenfield for emerging market from 25 MTPA to 169 MTPA. So what part of our emerging business can be supported by this facility? So once this facility comes alive, can we get to our aspirational target of 15% EBITDA in our emerging market business?
No, I think you are mixing up two things. I think you are talking of API facility, correct? Metric ton capacity is API.
Yes.
Oh, yeah, exactly.
Yeah.
So API, as our strategy is very clear, it's more for our own backward integration. Bulk of it will be used for our own APIs that we use. Maybe a little bit we will sell in the market, but that's not the driver. It's more on a backward integration, quality control and consistency, availability, etc.
It's more a strategic positioning than the business vertical.
Yeah, it's not a driver, exactly.
Okay. So we have not yet planned regarding our specific plan for the emerging market, right? As of now.
No, that API facility is already on ground and it will be commencing production very soon. It is actually already commenced.
In March.
Okay. Thank you. That's it from my side.
Yeah. So again, I'm saying API facility, we are planning for a FDA trigger by Q2 2026. All efforts are ongoing currently to get FDA trigger by that time frame, as we speak. Currently, till we get FDA trigger for the utilization of facility, we are already working on multiple ways how we can utilize that particular 100 metric ton of capacity on API side. A lot of efforts are ongoing on that particular side of the business as we speak. And as we said, facility is already commenced. A lot of validations are going on. So commercial activity will start from next month. Commercial execution, billing activity. But again, I'm saying this is strategic positioning. We don't look at it as a vertical of business as we speak.
Okay. Thank you. And what is the capex for FY'26?
250 crores.
Sorry?
500 crores. We have written that in the present. 250 crores.
250. Okay. Thank you.
Thank you.
Thank you. We have the next question from the line of Mitesh Mehta from Long Term Investment Group. Please go ahead.
Good evening. Am I audible?
Good evening. Yeah.
Yes.
Am I audible? Yeah. Thanks for taking my question. I have two questions. One is related to group company. So as I understand, there is one group company which is in similar line of business. And is there any further plan to merge the business, or how do you plan to cope up with the overlap of businesses, especially?
So Mitesh bhai, So in one of the previous questions, which was the same question Swapnil has clarified, and we are very clear. One, it's a completely different and clearly different strategic business. The Remus that you are talking about, the group company, it is into distribution. It has multiple distribution products and channels. We are only in OSD and manufacturing as Senores 100% pure manufacturing. and they have absolutely no presence in regulated market. Correct.
Okay.
So they also, Remus also acts as one of our distributors with maybe 2-3% of our sales going through them. And therefore, at this point in time, we have not thought about anything. It's a completely non-conflicting separate line of business, and for the timing, it will continue as it is.
Okay. And my second question is regarding, like our company has a very high number of receivable days and even payable days compared to other US-focused formulation companies. So is there any specific reason, and do you have a specific plan to reduce that, and if so, by what extent?
No, if you see our presentation, I think compared to 2024, we have already reduced the number of days. From 69 days in 24, we are at about 43 days of inventory in this year. Trade receivables have also reduced to half, from 228 days to 108 days. And payables have also reduced. So we are already in the process of reducing, but we feel that still there is some improvement to be done, but it will be gradual.
I will also clarify, FY'24 is actually not strictly comparable because that was the year where different businesses got consolidated for different periods, and then the year-end position showed a very skewed position. Correct. So generally, based on our model, about 190 to 100 days of receivables in US is quite okay because there are two elements. One is our COGS that we bill as a supply, and second is the profit share. And that profit share always takes time. It doesn't happen quickly. And then inventory we have to carry. Payable also will come down significantly as we speak because of the fact that after the IPO proceeds, a lot of funds will go into working capital and everything will be streamlined. But net, my working capital cycle will further improve going forward. That is what our plan is.
Okay. And one more question is considering long-term implication of US dollar softening, now there is a more chance that US dollar will soften compared to Indian rupees as well as all emerging market currencies. So do you have a specific long-term plan for same?
No, so see, there are two aspects. One, if I'm exporting from here into US, I'm more worried about this. I am a US company, manufacturing in US, buying in US, selling in US. So to that extent, doesn't matter. Correct. Secondly, we are too small a company globally to talk about the global impact of dollars, but let's see. We are also waiting and will be guided by experts like you who can advise us what is to be done.
Okay, thank you. That's it from my side.
Thank you. Ladies and gentlemen, due to time constraints, we will take the last question from the line of Smith from RGI. Please go ahead. Mr. Smith, can you hear us?
Hello?
Yes, please go ahead with your question.
Yes.
So, what was the full year revenue for Retnaris on standalone basis?
Emerging market.
121 crores.
Yeah.
And what was the YOY growth?
YOY growth.
YOY growth was, I think last year was not the fully consolidated, but on full year basis it was at 107 crores, which didn't get consolidated in our books. Because we added it in December.
But it's not apple to apple comparison because there's a lot of change in the products. So we have discontinued quite a few products, introduced quite a few new, more profitable products. But still on a pure arithmetic, it is 107 versus 121.
Got it. And my second question is on approved ANDAs. So it has increased from 24 to 61 compared to last quarter. But our number of products under our pipeline is more or less similar. So is it because of the acquisition only?
Yes.
No, so one is acquisition and secondly it always takes time to commercialize a product after, once the NDA is approved, ANDA is approved. But as we spoke in the initial remarks, what Swapnil said, almost 31 new products are expected to be launched in the current fiscal. Which will also partly include...
Yeah, I'm just talking about approved ANDAs.
Yeah, so this, whatever we acquired, they are all approved.
They are all approved.
Approved ANDAs. These are all approved ANDAs.
That includes the 16 products that we have acquired, 16 ANDAs.
So the reason behind this, this improvement is just in this acquisition.
Yes. Partly yes, but partly even if you knock it off, there's still growth.
No, we don't have.
And what is your guidance for next year EBITDA margin?
No, I think Swapnil gave a target that we expect the PAT margins to significantly grow and PAT in absolute terms to double as compared to this year. So there would be a margin improvement, but it is a bit early for you or for us to give exact what growth in PAT. In absolute terms, it will be double. Margins will be improved, but to what extent? Let us see. There would be 100% improvement, but volume growth in PAT will be almost 100% as compared to this year.
So, is it 25% EBITDA margin is sustainable? Can we assume that?
100%. It will only improve.
It is sustainable.
100% sustainable. Yeah.
And what about the business comes under other segments?
Sorry? Other than regulated and emerging, you are asking?
Yes, correct.
So one, we have a critical care business, which is hospital supplies of injections, critical care injections to hospital supplies, and then there's a little bit of API sale. These two are the main components of the third vertical.
Is it for, regulated market or emerging market?
No, 100% India.
Okay. And, is it sustainable?
Of course, it will further grow. Largely, Smith, here it's a branded generics, right? We are approved in more than 100 plus, 120 plus hospitals across India. And in fact, month over month, we are seeing about 100% growth on the branded generics in India. So as Sanjay Bhai said, this will continue to grow as we move forward. In post current quarter, we can give you a little more guidance in terms of how we see that particular vertical to grow in this particular year. We have strong guidance, but let's see how it goes post this quarter.
Understood. Yeah. Thank you. That's it from my side.
Thank you.
Thank you.
Thank you. That was the last question. I would now like to hand the conference over to Swapnil Shah for closing remarks.
Thank you. I would like to once again thank everyone for joining the call. We will keep updating our investor community on a regular basis for the developments at Senores. I hope we have been able to answer all your queries through our answer that we have given to the questions that were asked. I once again thank you everyone and have a great weekend. Thank you.
Thank you.
Thank you. On behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.